Intel just announced plans to raise $15 billion by selling new shares. Normally, that would sound like bad news. Issuing more stock dilutes existing shareholders. Each investor owns a slightly smaller piece of the company, and Intel's shares fell after the announcement. But the timing tells a much more interesting story. Intel's stock has nearly tripled this year. Demand for its server processors is rising. Its data center business is improving. And instead of using that recovery to conserve cash, Intel is taking advantage of the higher share price to raise one of the largest equity financings in its history. The money is intended for general corporate purposes, including capital expenditures and working capital. Intel has also given underwriters the option to purchase another $2.25 billion of stock. So why does a company benefiting from the AI boom suddenly need another $15 billion? Because Intel is trying to do something much harder than simply sell more processors. It wants to rebuild itself as both a major chip designer and a world-class manufacturer capable of producing advanced chips for other companies. And semiconductor factories are extraordinarily expensive. Intel's problem begins with a strategic mistake that developed over many years. For decades, Intel had one of the most powerful business models in technology. It designed its own processors and manufactured them inside its own factories. That gave Intel enormous control over technology, production schedules, and profit margins. But manufacturing became increasingly difficult. TSMC concentrated on producing chips for many customers. Because Apple, Nvidia, AMD, Qualcomm, and other companies could all use the same manufacturer, TSMC could spread the enormous cost of new factories and manufacturing technologies across a much larger customer base. Intel largely depended on its own processors to fill its factories. When Intel's manufacturing roadmap slipped, the problem became circular. Delayed manufacturing made Intel's processors less competitive. Less competitive processors weakened demand. Weaker demand made it harder to justify enormous factory investment. Meanwhile, competitors could use TSMC's newest manufacturing technologies without owning factories themselves. Intel's turnaround strategy tries to break that cycle. The company is opening its factories to outside customers through Intel Foundry. Instead of factories existing mainly to manufacture Intel processors, Intel wants them to produce chips designed by other companies too. The logic resembles a hotel. Building a hotel is expensive. If only employees from one company are allowed to stay there, many rooms may remain empty. Open those rooms to thousands of customers, and the same building can generate far more revenue. Intel wants to do something similar with semiconductor manufacturing. The factories already require enormous investment. The goal is to fill them with both Intel products and external customers. That sounds straightforward. It is not. Modern semiconductor manufacturing is one of the most difficult industrial businesses on Earth. A company can spend tens of billions of dollars building a fabrication plant before producing meaningful revenue from it. And the customer relationship is unusually demanding. If an AI company designs a chip that costs hundreds of millions of dollars to develop, it needs confidence that the manufacturer can produce it reliably at high volume and with competitive performance. A manufacturing delay of several months can destroy an entire product cycle. This is why Intel's upcoming 14A process matters so much. Intel is targeting high-volume production using 14A around 2028 as it tries to demonstrate that its manufacturing roadmap is competitive enough to attract major external customers. Reuters reported that Intel is increasing investment in manufacturing and advanced packaging while exploring customer relationships that could include companies such as Tesla and potentially Apple. But Intel cannot wait until 2028 to generate cash. Fortunately, something unexpected is helping fund the transition. AI. Not all artificial intelligence workloads run only on NVIDIA GPUs. AI data centers still need traditional server processors or CPUs to manage operating systems, storage, networking, databases, preprocessing, and many other tasks surrounding the accelerators. As AI data centers expand, demand for CPUs can rise alongside demand for GPUs. Intel's latest filings show how quickly this is affecting the business. Its data center and AI segment saw server revenue increase by about $2 billion year-over-year in the second quarter. Server volumes increased 9%, while average selling prices increased 48% as customers purchased more premium processors. Intel said hyperscaler demand was a major driver, and that demand exceeded available supply because of internal constraints. This creates a surprising reversal. A few years ago, investors worried that AI would make Intel increasingly irrelevant because NVIDIA GPUs were becoming the center of the data center. Instead, AI is helping revive demand for one of Intel's oldest businesses. That does not mean Intel has defeated NVIDIA. It means AI infrastructure is much larger than GPUs alone. Imagine an AI data center as an enormous restaurant. The GPU is the chef performing the specialized task everyone notices. But the restaurant still needs managers, inventory systems, delivery operations, payment processing, refrigeration, and scheduling. CPUs coordinate much of that surrounding activity. The more AI infrastructure companies build, the larger that supporting system becomes. Intel is benefiting from that growth. Its total Intel products revenue reached $15.1 billion in the second quarter, up $3.3 billion from a year earlier. Data center and AI operating income improved by approximately $1.8 billion year-over-year. Intel also reported growing demand for purpose-built silicon, including ASICs. That improvement helps explain why investors have become much more optimistic. But it also creates the perfect moment to raise capital. When a company's stock price is depressed, issuing shares is painful because it must sell a large percentage of the company to raise meaningful cash. When the stock price rises dramatically, the same amount of cash requires fewer shares. Intel's stock had nearly tripled this year before the offering, according to Reuters. That gives management an opportunity to strengthen the balance sheet while investor demand is unusually strong. The offering reportedly attracted more than $100 billion of interest, highlighting how dramatically sentiment toward Intel has changed. The strategy still comes with a cost. Existing shareholders are diluted. Intel had approximately 5.043 billion shares outstanding as of late June. The new offering adds a significant number of additional shares depending on the final sale price, and underwriters can purchase another $2.25 billion if demand remains strong. So shareholders are effectively making a trade. They give up part of their ownership percentage today. In return, Intel receives billions that could improve its ability to finance factories, advanced packaging, and future manufacturing technology. If those investments succeed, the company becomes more valuable despite the dilution. If they fail, shareholders suffer both dilution and poor investment returns. This is why Intel's share sale is not simply a financing event. It is a referendum on the turnaround. The company is also spending much more. Intel's capital expenditure forecast for 2026 has risen to about $20 billion, and investment is expected to increase further as it develops advanced manufacturing capacity. That spending creates another important contradiction. Intel needs factories to compete with TSMC. But building factories before customers commit creates enormous financial risk. Customers want proof that the technology works before committing billions of dollars. Intel needs customer commitments before it can safely justify billions in investment. Someone has to move first. Intel is choosing to move first. The company is also trying to reduce some of the financial pressure created by previous manufacturing investments. Reuters. Breaking Views noted that Intel is working to repurchase Apollo Global Management's stake in an Irish semiconductor facility. The transaction could improve future earnings by bringing more of the economics back inside Intel, although it also requires capital. This illustrates the complexity of the turnaround. Intel is raising equity, investing in factories, reorganizing manufacturing partnerships, developing new process technology, increasing production capacity, and simultaneously trying to sell competitive processors in markets where AMD, NVIDIA, and custom chips continue advancing. Most turnarounds require fixing one broken business. Intel is trying to fix two businesses that depend on each other. Its products must become competitive enough to generate cash. Its factories must become competitive enough to attract customers. If either side fails, the other becomes harder to sustain. But AI is giving Intel something it did not have several years ago: time. Server demand is strengthening at exactly the moment Intel needs revenue to fund manufacturing. Supply constraints are even limiting Intel's ability to satisfy all current demand. The company said industry-wide constraints could persist into next year while it adds factory capacity. That is a much better problem than having empty factories. Yet it introduces another risk. Current CPU pricing is benefiting from scarce supply and strong hyperscaler demand. If supply catches up or competitors increase capacity, prices may normalize. Intel cannot assume that today's unusually strong pricing environment will fund its turnaround forever. And the biggest uncertainty remains external foundry customers. Intel producing Intel chips does not prove Intel Foundry can become a TSMC competitor. The decisive moment comes when major outside customers commit important products to Intel's manufacturing technology. That is why every potential 14A customer matters so much. One high-profile customer validates the technology. Several customers begin filling factories. A broad customer base transforms the economics. Until then, Intel Foundry remains a very expensive promise. The $15 billion share sale buys more time to prove that promise. And that may be the real story behind Intel's resurgence. The AI boom did not suddenly make Intel the dominant AI chip company. It created enough demand for Intel's traditional strengths to become valuable again. Intel is now trying to convert that temporary advantage into something permanent. More server revenue funds more manufacturing. More manufacturing investment improves future technology. Better technology attracts external customers. External customers increase factory utilization. Higher utilization lowers the cost of manufacturing. That is the cycle Intel wants to create. For years, the cycle worked in reverse. Now management is trying to make it spin forward. The $15 billion offering tells investors that Intel believes the opportunity is large enough to accept dilution today in exchange for manufacturing capacity tomorrow. If Intel's 14A technology attracts major customers and its server business remains strong, raising capital after a massive stock rally could look like one of the smartest moves in the turnaround. But if foundry customers fail to arrive, the company may discover that raising money was the easy part. The difficult part is convincing the semiconductor industry that Intel's factories deserve to matter again.